And good afternoon, everybody. Welcome to ETF Edge, your go-to place for everything ETFs. Got an interesting show today. A lot of very important things happening in the ETF world today. Joined today by Mike Akins of ETF Action and by Bryon Lake. He's the head of America ETF distribution for JP Morgan Asset Management. And Mike, let me talk to you first. I am getting an awful lot of questions about what's going on in oil today, and particularly what's going on with oil ETFs and the USO. That is the largest oil ETFs. And I think this might be a very good teaching moment for us to explain exactly how these work. And maybe you can help us out since you're an expert in this area. These commodity ETFs tend to own futures contracts. In the case of USO, they own the front month contracts, the two front month contracts, mostly the most immediate one and the one right after that. We're seeing the May contract, which is expiring tomorrow, collapse today. It's been fluctuating all morning between $5, $7, $8, $9. The June contract is $22. I'm wondering if you can explain why this is happening. Obviously, it seems like a very large number of people are trying to get out of the May contract. I understand that about 25% of the contracts may be owned by USO at this point, and a lot of people are simply trying to get out and sell at any cost and don't want to take delivery of this. Can you give us a little explanation of what's going on here?
Certainly. So first and foremost, it's important to note that USO is no longer in the May contract. USO's methodology is to roll out of their contracts 2 weeks prior to expiration. So actually, they rolled out of May into June the week of April 7th. They do that over a 4-day period. So with respect to what's going on currently with May into June and that huge contango, that huge disconnect between the price of May contracts and June contracts, it is not directly related to USO, even though USO, as you said, does own a significant percentage of contracts of the month they're currently holding. So right now they're currently holding the June, and as you alluded to, 20% of that is into July. And the reason they recently made that change from June to July is simply to allow for more liquidity and to deal with ownership limitations around single contracts. So they were approaching over 25% of the ownership of the June contract and needed to change that methodology to avoid breaking those single ownership rules in the contracts.
So let me just ask the most immediate question, because the ETF haters are going to be out and they're going to be saying, aha, the reason we have this disconnect, this huge difference between the May and the June contract suddenly is because some of these ETFs own a significant amount of these contracts. They don't want to obviously take any possession. So people have been piling into them for whatever reasons, Mike, to short them or to hedge them, and that's causing some kind of disconnect. It's not the ETFs that are causing the particular problem here. I want to get that from you. What is your opinion?
So specifically with the May to June right now, that would not be USO simply because it already rolled out of its contracts. Now, the ETFs in general do have a play in this, and with respect to USO in particular, I think it's important to point out to the audience that historically USO has had an inverse relationship. The price of USO has been an inverse relationship to the shares outstanding. That meaning that as price goes down, shares outstanding have historically gone up and vice versa. And the rationale for that is because the demand, as volatility increases in the price of oil, the demand for this product goes up. But it's very important not to use that as a way to assume that people are getting long the price of oil, because these strategies, these are trading tools. They're not allocation tools alone. And as a result, as you mentioned, flows don't dictate the position of the actual traders.
Right. And Mike, I don't know if you have any thoughts on this in general on how these commodity ETFs work, but this is what I saw last week. We saw huge inflows into some of these commodities, into USO, but obviously some people felt they're probably not betting that oil is going to go up. They're probably betting, at least in a short term, a short here at this point. So do you have any thoughts about how these are constructed, these commodity ETFs in general, and what, if anything, we can do to improve them, or do they need any improvement?
So I don't think they need any improving. They are designed to be a tool, and directionally they capture the movement of oil. As you get into steep contangos, or historically, looking back, past recent 10 years, backwardation would actually go in your favor to do the roll. You have to understand that there's going to be a negative roll yield right now with the steep contango, and understand how long you want to be in the market. But I always say with respect to these trading tools, there's a lot of tools at Home Depot I can buy that I have no business using. And that's very important to note that a lot of these ETFs, you can buy them, but you need to really understand them before you start using them.
Yeah. Well, Bryon, isn't that the problem with these commodity kind of ETFs or anything where you're owning futures contract? You have what Mike called that negative roll yield. So if you have to pay more for the futures contract the next month, you're over time, you've got this perfect decay. You're guaranteed essentially to lose money. Here's a particular situation where it's going to be fairly difficult. Any thoughts on what we can do to improve the ETF role here, or is there any problems at all? Maybe I'm trying to create a problem where there isn't one.
Yeah, no, I don't think there is a problem here, Bob. Right? I think there's a couple of things going on. First of all, this is a really efficient way for investors to express a view, and so if they're able to use this ETF to express that view, that's a tool that is helpful to their portfolio. The second thing is just taking it back to a little bit of history here and why the futures contracts were invented in the first place. It's next to impossible to get spot price or to store oil. It's very expensive. In fact, I was Googling it earlier today. I think a used oil tanker is about $42 million right now. And you can only hold about 2 million barrels of oil on that. And so you create a futures contract in order to give yourself the ability to get the exposure or hedge your exposure or your risk within your portfolios. And so by having it delivered through an ETF vehicle that's exchange traded, that's available in these structures, that actually is a helpful tool for investors to express their views. They just need to make sure they understand how they work.
Right. And Mike, last week, just getting back to the point, because I got a whole bunch of emails about this, there was a huge number of creations last week in the USO. And I know you say it moves creations tend to move in opposite direction to the price. Is this people who are betting that suddenly oil is going to dramatically increase over the next couple of months, or is it hedge funds who are hedging or shorting? What creates there was a dramatic increase in new creations last week.
So it's all of the above. To the extent that, looking at flows into this product in particular does very little on a real-time basis to understand how the product's being used. I'm certain there's a portion of this that is long. People are saying, oil can't go any lower. I want to get a short-term directional bet on it. There's folks that are trying to short it, but because of regulations, there's not enough shares outstanding. So as a result, there's this mechanism called create to lend, where the authorized participants are creating shares so they can lend them out to people that want to go short. And there's a million different vehicles in between with respect to hedging and different active trading strategies where folks are using this product in line with other products to reach certain outcomes. So it's just really important to note that there's no real connection in the short term to the flows of these other than they need the liquidity, and shares outstanding increases liquidity. And that's why you see an inverse relationship between shares outstanding and volatility.
Okay, we're not going to solve anything. I'm bringing this up. I've dwelt on this for a little bit of an extended period because I think there's going to be a lot of post-mortems on this, and I think the people who are unhappy with the ETF structure are going to try to use this as a scapegoat to point out certain deficiencies they find in this. I don't, and I agree with you guys, but I think it's going to be out there for a while now. I want to move on and talk about dividend ETFs. Got a lot of questions about this. We've had about 20 companies in the S&P 500 cut their dividends in the last several weeks. So it's not a huge amount, but it's almost 5% of the S&P 500. I'm talking about eliminate their dividends at this point. I've noticed something, Mike and Bryon, and either one of you can weigh in here, that the dividend ETFs have significantly underperformed the market for the most part. So the S&P 500 is down about 12%, but the big ETFs in the dividend space, Vanguard High Dividend Yield, down 17%. The Aristocrats, NOBL, that ProShares has, down 17%. High dividend from iShares, the Spider dividend is down 20%. That's a significant underperformance, almost 50% weaker than the S&P 500. I'm wondering why that is. It's curious to me because most of these, like Noble, they are specifically designed to have companies in it that are increasing their dividend on a regular basis or maintaining a comparatively high dividend. Seems to me if suddenly some companies were cutting their dividend, they would be dropped from these if they were in the indexes. But investors don't seem to be looking at it that way. Bryon, do you have any thoughts on dividend ETFs in this juncture?
Yeah, so Bob, I think we're seeing a couple of things play out. First of all, the leadership in this market has been primarily driven by mega tech, which don't typically pay dividends, and so some of the dividend-paying companies have lagged because of that. We're actually seeing investors looking to rotate more towards quality. They're very interested in companies that have strong balance sheets to manage their ongoing business expenses, pay down debt, that they don't have leverage. And that'll help them navigate some of these markets. Some of those companies do pay dividends, but not all of them. And so I do think there will be some differentiation, and it's mostly down to the leadership in this market right now.
And Mike, you feel the same way? That makes a lot of sense to me. If you want quality is a strong balance sheet. That's certainly what you want in this kind of environment. I guess a dividend, as Bryon said, may be an aspect of it, but doesn't necessarily have to be. Would that account for why we're seeing an underperformance? A dividend isn't as important at this point as strong balance sheet.
Absolutely. I think the biggest thing to remember with dividend ETFs is dividend is in a lot of names in ETFs. There's 177 ETFs and just listed in the US that have dividend in their name with over $200 billion following those products. At the end of the day, dividends can be used a number of different ways to create very different portfolios. So as Bryon said, he's seeing a rotation to quality. Well, those dividend ETFs that have quality characteristics, such as a DGRO or a VIG, have performed much better and in fact are outperforming the market year to date. So it's important to keep the context of dividend and the methodology around how the dividend is being used, whether it's yield, which if you're just using yield tends to lead to value. And from that perspective, we know what's going on in the market from a perspective of value versus growth, and you're seeing the very similar thing with dividends. The other thing I always tell people with respect to any sort of screening methodology and any sort of ETF is to understand your sector exposures. And depending on how you're screening using dividends, it can lead to massive overweights. For example, HDV has nearly 25% of its portfolio in energy because it's focused in on those higher yielders, and it uses a Morningstar's moat characteristics, which is not the same as a balance sheet item as far as looking for that quality balance sheet. So the dividend ETF, it's just important to note that the word dividend doesn't necessarily have anything to do with yield. It's the way they're using that dividend to get to the end portfolio.
Thank you. That's a very good explanation. I appreciate that. Bryon, we haven't had you on before. I wonder if you could comment on a phenomenon we've seen in the last few weeks. We've talked about it last 2 or 3 weeks about how the certain bond ETFs have been trading at premiums to their net asset value recently. We saw this with HYG, some of the high yield ETFs. We saw this with some of the corporate bond ETFs like LQD. And obviously, the explanation, of course, is the Fed has announced they're going to be buying ETFs, and some investors seem to be wanting to front run them, essentially, and own them at this point. But I'm wondering about how you feel about some of these occasional disconnects you see between the actual prices of these ETFs and the corporate bond in the bond space. And their net asset values. Our guests in the last few weeks have basically said, let's hope that we get more aggressive ways to price bonds. It's not ETFs that are wrong. It's the bond pricing that's a little slow. What's your thoughts on that, just generally?
Yeah, Bob, I would pick right up on what your previous guests had said and agree with them. Fixed income delivered to the ETF wrapper gives you this massive benefit of having the efficiency of trading on the exchange, where you have that 100% transparency. You know exactly what you own, but importantly, you have what we would call price discovery. And so you have many market participants that are buying and selling, exchanging shares in the marketplace, and that tends to lead to more efficiency in pricing and give you that price discovery. And so the ETFs actually become a very accurate reflection of what's actually happening into the underlying markets. Number of
so what do the bonds have to?
Yep, go ahead.
Go ahead. I'm sorry. Finish your thought.
No, I was just going to add that there's a number of institutional investors out there that will actually use fixed income ETF trading as a proxy for pricing. In so many ways, it becomes the market due to that nature.
So Mike, what do we what do we do here? I agree with Bryon. It's not the ETFs. Again, the ETF haters say, aha, you see, there's something broken with the ETF. It's not the ETFs. It's the bond pricing mechanism that's broken. ETFs are very accurately reflecting where the market wants to go. But we still have this question of how to price the bonds better. What can we do about this? Is it more electronic trading? Better price discovery? What's the answer to this, to close this gap?
Well, I'm not sure there's an easy answer. I think Bryon did a great job describing what's going on. But with respect to the ETF marketplace specifically, it's simple supply and demand. It's supply and demand with an arbitrage mechanism built in, and that arbitrage mechanism allows it to not become a closed-end fund, so it can control premium and discounts. But with respect to the bond market, in times of illiquidity or liquidity events, you have situations where the underlyings just aren't pricing at all. And because the ETF is there, it, as Bryon said, becomes a price discovery tool. Now, it's not all good. If you're using ETFs that are less liquid on the secondary tape and you're not skilled at trading these products using proper limit orders, it can create serious issues for the secondary market as well. But primarily, the ETF is presenting that opportunity as price discovery. And if there's no trade on the underlying, then this is the next best case. And it's not always perfect, but it's better than not having a price at all.
Yeah. All right, guys, we're going to have to wrap it up. I want to thank you both for joining us. A little complicated subject today on USO, but this was a teaching moment to let people know exactly how these things work. Sometimes people forget or they're not fully aware, and that's what we do here on ETF Edge. And that does it for this week's ETF Edge. I'm Bob Pisani, and my thanks to Mike and Bryon for joining us today. Thank you for watching. You can find all of our videos, of course, on our website, etfedge.cnbc.com. We'll see you next Monday to break down the ETF business once again. Thank you for joining us.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.